What to watch out for in this Reserve Bank policy? Well, people normally watch out for Reserve Bank's interest rate. What RBI and the Monetary Policy Committee set is the repo rate, which is at 6.5% now. It is the rate at which a central bank gives money to banks when they fall short of cash. The repo rate enters the banking system through the call rate because Reserve Bank has a duty to keep the call rate close to the repo rate. Now, what is this call rate? That is the rate at which banks borrow from one another for 1 day. They borrow because under the cash reserve ratio, the CRR rule, they have to keep 4% of their total deposits in cash. Also, they can borrow in the call market because of sudden deposits or withdrawals. Now, the call rate is very important. Both the RBI and the MPC control only this rate. Now, if 1 day money is set at 6.5, then 1 month money, 1 year money, and 10-year money will all accordingly be a little more expensive. Thus, the whole yield curve is created. Now, although Reserve Bank and MPC are not expected to change the repo rate in the current policy, what Reserve Bank says about the call rate is important. This is because although Reserve Bank has to keep the call rate at the repo rate fixed by the MPC, for the past 5 months, call rate has been at 6.75 and not at 6.5%, which is the repo rate fixed by MPC. Why is the call higher? 2 reasons. First, government was very slow in spending its money. So bank deposits, which went from bank accounts to the government on advance tax days, just sat with the government for too long. The money doesn't get spent. It does get spent on month ends for salaries, etc. But still, there has been a large surplus with the government for the past many months. A second reason why call rate went 25 basis above the repo was because the Reserve Bank too wanted it that way. Inflation numbers in July and August were unusually high at 7.8 and 7.5%, and hence the Reserve Bank wanted to do a stealth rate hike. From September, it kept liquidity tight and the call rate remained at 6.75 for the last 4 to 5 months. If it had wanted, Reserve Bank could have provided money via repo auctions to banks, but it didn't. Reserve Bank kept pointing to its stance of removal of accommodation. How can we give money via repo when our stance is removal of accommodation, they argued. But 2 things have happened lately. Inflation for November and December came in way below RBI forecasts. We got the December inflation on January 12th. And the surprise on Jan 25th was Reserve Bank gave the banks 2.5 trillion rupees through a repo auction. By February 2nd, that is Friday, and through the current week, the call rate has fallen to 6.5% from the 6.75 that prevailed in the past 5 months. Of course, besides the Reserve Bank's repo, the government also spent more money in January end for salaries and other bills, thus bringing back liquidity into the banks. So can the market be sure that Reserve Bank will keep the call rate at 6.5 by regularly providing liquidity through repo auctions? No, because even as call rate dipped, Reserve Bank also announced a reverse repo auction, offering to take back money from banks. Now, banks need to know if the call rate will fall. If call rate is high, banks try to raise money from depositors and push up deposit rates. A bulk of the market believes the Reserve Bank will let the call rate fall towards 6.5 because inflation, especially core inflation, is down very sharply. Another big reason why markets expect the Reserve Bank to keep call rate lower is because government has announced a lower than expected fiscal deficit for the current year and the next year. Now, if the government doesn't spend much, automatically inflation tends to fall. So logically, Reserve Bank should revert to letting the call rate be at the repo rate of 6.5%. In the February 8 policy, bankers will watch to see if RBI hints that it is comfortable with call at 6.5. Secondly, is RBI okay providing liquidity via repo to bring down the call? If they are, then why should they retain the stance of removal of accommodation? After all, they are providing the accommodation. So will RBI change stance? Or will they at least prepare the markets for a change of stance? Markets can look for other hints of dovishness, like Reserve Bank cutting its inflation forecasts. Finally, if stance changes from withdrawal of accommodation, markets will start wondering whether the next step is a rate cut, and when will that be?